The banks hammered silver down to 61.96. They want you to believe the rally is over. They want you to think silver is just a speculative bubble that popped. They are lying. Not a small lie. This is a lie of omission so massive it borders on criminal negligence. While you were staring at the comic strip tickers yesterday, while algorithms were dumping paper contracts in New York, something happened in South Korea that makes the price of silver irrelevant. Something that changes the fundamental chemistry of the global energy transition. Samsung SDI, one of the largest battery manufacturers on Earth, quietly confirmed the specs for their new solid-state production line. The media calls it a battery breakthrough. 900-mile range, 9-minute charging. But they're missing the most crucial detail, the one Wall Street hasn't priced in, the one mining companies aren't ready for. The detail that makes a 1.1 billion ounce silver deficit look like pocket change. The secret? It's not lithium, not cobalt, not nickel, it's silver, and not just a trace amount. We're talking about a massive structural jump in silver consumption per vehicle, a technology that transforms silver from a precious metal into a strategic energy metal. In this 4-part deep dive, I'll expose the silver bomb Samsung just dropped on the global supply chain. I'll walk you through the chemistry of the silver-carbon anode. I'll do the math the IEA refuses to publish, the math that proves there isn't enough silver on Earth to electrify the fleet using this technology, and I'll show you why Friday's price drop to $62 wasn't a crash. It was your last chance to buy silver before the auto industry realizes they've made a fatal miscalculation. The banks are playing a paper game. Samsung is playing a physics game. Physics always wins. This is the story of the silver-carbon revolution. To understand why this is an extinction-level event for silver supply, you need a little chemistry. Don't worry, I'll keep it simple. For 30 years, the world has run on lithium-ion batteries. Your phone, your laptop, the Tesla in your driveway. They all use liquid electrolyte lithium-ion batteries. They're great, but they have a fatal flaw: dendrites. When you fast charge a lithium battery, or just charge it too many times, lithium ions form needle-like crystals called dendrites. They grow jagged roots inside the battery. Eventually, they pierce the separator, the wall between anode and cathode. When that happens, short circuit, thermal runaway, fire. This is why EVs take 45 minutes to charge, why they catch fire, why they lose range in winter. The holy grail has always been the solid-state battery. No liquid, no fire risk, instant charging, double the range. Every company from Toyota to Volkswagen has promised this for a decade and failed. Why? Because they couldn't stop dendrites from forming on the anode. Graphite anodes didn't work. Silicon expanded too much. Pure lithium metal was unstable. Then Samsung SDI cracked it. They discovered one element applied as a nanocomposite layer that solved the problem completely. It allowed lithium ions to move freely, but stopped dendrites cold. Stable, conductive, perfect. That element is silver, specifically a silver-carbon nanocomposite layer. This isn't theory, it's published science. Samsung's prototype cells use a thin layer of silver mixed with carbon to regulate lithium deposition. Silver acts as a host, dissolving lithium evenly and preventing spikes. The result: smaller, lighter, faster, safer batteries. But here's the catch, a massive catch. To make this battery work, you need silver, not micrograms, grams. For the first time in history, silver isn't just used for conductivity. It's active in electrochemical storage, part of the battery's DNA, and the auto industry is about to scale this tech to millions of cars. Think there's no problem? Let's put it in perspective. A standard combustion car uses 15 to 20 grade of silver. Window switches, seat motors, defrosters, ECUs. An EV? 30-50 green in inverters, battery management, high voltage cables. This already contributes to the 1.1 billion ounce silver deficit. But solid-state batteries change the game. We aren't talking switches anymore. We're talking coating the anode of every single cell in a 1000 lb battery pack. Early Samsung estimates 5 to 10 Jd of silver per kilogram of anode. Aggressive estimates 0.5 to 1 kilos of silver per vehicle for high-performance packs. Let's be conservative. Suppose it adds 50 grain per car, that's roughly 100 grain per EV. Globally, 90 million cars are produced each year. If just 10% adopt solid-state batteries. 9 million cars, X100 green mire 900 million grams, about 29 million ounces of new silver demand. Sounds manageable? That's 10% adoption, conservative numbers. What if it's 50%? What if silver loading is 200 grand per car? By 2027-28, if Toyota, Samsung, and Volkswagen hit mass production targets, automotive silver demand could jump from 90 million ounces per year to 200-300 million ounces. Where does that silver come from? Comics? Only 30 million ounces left. Miners, global production is flat at 830 million ounces. This single technology, silver-carbon anodes, could consume 25 to 35% of global mine supply just for EVs, leaving zero silver for solar panels, electronics, jewelry, zero for you. And Samsung just confirmed their pilot line. This isn't a 2035 story, it's happening right now. While banks smashed the price to $61.50 on Friday, Samsung procurement officers were likely locking in long-term silver contracts. They understand the math. Without silver, their billion-dollar battery factories are worthless. This represents a fundamental shift in demand. Silver used to be an industrial spice. You sprinkled a little on a circuit board or light switch. Price didn't matter. But with solid-state batteries, silver becomes structural. A major line item in the bill of materials, if a pack requires 500 grit of silver at $60 Oz, that's $1,000 of silver per car. At $100 Oz, that's $1,600. Auto manufacturers run on razor-thin margins. A $600 cost increase per vehicle destroys profit. So what's their strategy? Thrifting. They'll try to use less silver. They'll try to engineer it out. They might swap pure silver powder for silver-coated carbon. But chemistry is stubborn. You cannot cheat the electron. Reduce the silver and the dendrites return. Dendrites return and the car catches fire. Would you buy a silver light battery if it had a 5% chance of exploding in your garage? No. Samsung knows it. Toyota knows it. They cannot cut corners without risking safety. They're hostage to the periodic table. This makes demand inelastic. We saw it with solar panels. Now we're seeing it with EVs. Two massive global industries, energy and transportation, are simultaneously pivoting to technologies that require massive silver, colliding with a supply chain starved of capital for a decade. Friday's price dropped to $61.50. Laughable. We are heading toward a future where silver is as critical as oil. Imagine oil running out, yet prices drop to $2 a barrel. Would you panic sell gas or fill every tank you own? Why isn't CNBC screaming this? Why is Bloomberg hyping lithium oversupply but ignoring the silver squeeze? Because the narrative hasn't caught up to the lab. Wall Street analysts are lazy. They look at spreadsheets from 2020, assume EVs, arc lithium plus nickel, treat silver as a legacy metal for mirrors and spoons. They don't read Samsung SDI's technical white papers. They don't study QuantumScape or Toyota patents. If they did, they'd see ag appearing everywhere. This information asymmetry is your edge. Right now, Saturday morning, the market misprices silver. Analysts think demand grows linearly, 2% a year. They don't see the step function change solid-state batteries represent. Remember palladium in the early 2000s? Auto companies switched to palladium for catalytic converters. Demand exploded, palladium shot from $200 to $3,000. Analysts were a decade late. The exact same setup is happening with silver. The silver bomb has detonated in R&D labs. The shockwave hasn't hit the charts yet, but it's coming. When Samsung launches the first mass-market car with this battery, when 20 ounces of silver in a luxury sedan becomes public, panic buying won't come from Reddit. It will come from Ford, GM, BMW, and they won't pay $61.50. We've established the technology. The silver carbon anode is real, superior, and coming. But now we must answer the terrifying question. Is there enough silver if every car company switches to this tech? If solar keeps growing, if investment demand continues, do the numbers add up? In part 2, I'll run the math of extinction. I'll calculate how fast global reserves hit zero under the Samsung scenario. I'll show why the recycling myth won't save us. I'll compare this setup to the 1980 spike and explain why $100 silver is actually a conservative target. Friday's drop was a gift, a system giving you one last chance to front-run the biggest industrial shift in history. The banks look at weekly charts. You need to look at the periodic table. Let's start with the base case, the world before the Samsung silver bomb fully detonates. Total global mine supply, 830 million ounces a year. Recycling supply, 180 million ounces a year. Total supply, 1.01 billion ounces. Current demand before solid-state adoption. Industrial, solar, electronics, 600 million ounces. Jewelry and silverware, 200 million ounces. Investment, coins and bars, 250 million ounces. We're already in deficit, burning 5,100 million ounces of reserves yearly just to keep the lights on. Now, introduce Samsung. Let's assume moderate adoption. By 2028, 20% of new EVs use solid-state batteries with 50G silver per vehicle. Global car production, $90 million diets. EV market share, 40%, 36 million EVs. 20% of EVs adopt SSB, 7.2 million cars. 7.2 million x 1.6 Oz silver, 11.5 million ounces, 11.5 million ounces Hertz. But it doesn't break the world, but that assumes a small car. What about a Ford F-150 Lightning or Tesla Cybertruck? Those batteries are massive, maybe 500 grand per vehicle. If average silver per EV hits 200 grand and 50% adoption occurs, 18 million cars x 6.4 Oz 115 million ounces. 115 million ounces is more than Peru's entire annual production. It's like another solar industry appearing overnight. Where does it come from? 1. Price destruction. People stop buying jewelry and silverware. 2. Investment cannibalization. Coins sold to Samsung. This is the extinction equation. Total supply solar, plus electronics, plus solid-state batteries. Investment demand isn't even counted. Industrial demand alone could consume 100% of mine supply. Silver ceases to be a public monetary metal. It becomes strategic, reserved for industry. Unobtainium. Skeptics scream, recycle it. That's the recycling myth. And dangerous. Politicians get a false sense of security. Gold recycles, whereas 90% because it's concentrated. Silver recycles 20% because it's dispersed. It's sprinkled in microscopic amounts across billions of devices, 0.1 G in your phone, 0.5 G in a laptop, a thin film in solar panels, nano layers in missile guidance chips. Extracting it costs more than it's worth, so it ends up in landfills. Solid-state batteries? Yes, they have more silver, but cars are recycled in 15 plus years. Silver going into a Samsung battery in 2026 isn't coming back anytime soon, locked away until 2041. Removed from the supply pool for a generation, the recycling wave everyone is counting on won't arrive in time to prevent the shortage of the 2020s. The deficit is structural, consumption is destructive, sequestration is long-term. The only solution to the Samsung scenario? More mining. But can we just dig more? If silver hits $100, surely miners will flood the market, right? Wrong. Welcome to the geological wall. You cannot print a silver mine. It takes 10-15 years to take a mine from discovery to production. Even if we discovered a massive deposit today, it wouldn't produce a single ounce until 2035. But Samsung and Tesla need silver now. Existing mines are dying. Ore grades have collapsed. In 2005, a good mine produced 15 Oz ton. Today, a good mine yields 4 Oz ton. That's 4x more rock to dig for the same silver, more diesel, more water, more labor. Mining is exponentially harder and more expensive. Politics makes it worse. Mexico produces 25% of global silver, but stopped issuing new open-pit permits. Peru constantly faces strikes and protests. Russia is sanctioned. So just as the silver-carbon anode is demanding 100 million new ounces, global mining supply is threatening to shrink. This is a pincher move. Demand exploding, supply collapsing, inventory gone. No relief valve. The only thing left to adjust is price. Enter the EV paradox. Governments have mandated the end of internal combustion engines, forcing EV adoption, subsidizing battery factories, but forgot to check the periodic table. If silver hits $200 Oz, solid-state battery costs skyrocket, EVs become unaffordable, and the transition stalls. Governments cannot let the transition stall. Political reputations are on the line. What will they do? Subsidize silver? Seize it? Remember the Defense Production Act? This is where it matters. If GM tells the White House, we can't build the cars you mandated, we can't get silver, the answer isn't forget the cars. The answer is, we'll get you the silver. Silver becomes a critical strategic material. Industrial allocation will trump retail investment. Sales of silver eagles could be banned to divert metal to battery factories. This is the nightmare for stackers who haven't bought yet. You won't compete with price, you'll compete with government mandate. Samsung isn't just a company, it's an economic powerhouse. The South Korean government will ensure Samsung gets silver. The US government will do the same for Tesla. Silver carbon anodes make silver a national security material, and national security always trumps the free market. We have the tech, the math, and the conclusion is undeniable. Structural, solvable shortage. How do you profit? Friday's drop to 6150 scared weak hands. But 6150 is a joke, a pricing error. In part 3, I'll pivot to solutions. Which mining stocks are best positioned, why numismatics could be a trap, and the exit strategy for when this mania hits. The tech is real. The shortage is real. The Friday dip is fake. Don't be shaken out. If you've watched parts 1 and 2, you now have information 99% of Wall Street ignores. The solid-state battery revolution requires a silver carbon anode. This single tech could consume 115 million ounces of new silver annually. The geological wall means mines cannot expand fast enough. So here we are, Saturday, December 13th. Silver closed at 61.50. The market is fearful. Retail investors panicked, but you are calm. This price drop is a glitch in the matrix, a temporary mispricing before the Samsung reality hits the ticker. Knowledge without action is useless. How do you position yourself to profit? Coins, miners, ETFs. Here's the strategic playbook. Lane 1, physical metal. This is your insurance, your wealth preservation. In an industrial squeeze, rules change. Dealers have pushed semi-numismatics, collectible coins, limited editions, Star Wars silver, things that may hold value in a normal market. But we are entering an industrial vacuum. When Samsung needs silver for a battery, they don't care about Darth Vader, MS-70 grades, or collectability. They care about atoms. Raw silver to melt into nano powder for anodes. In a true shortage, premiums on collectibles collapse relative to spot price. If spot hits $100, the melt value of your coin is $100. Nobody will pay $150 for collectability when the world is starving for the metal itself. Strategy: stop paying for art. Start paying for weight. A 100 Oz industrial bar is the superior asset. 1. Lower premium, more silver per dollar. 2. Liquidity. Industrial buyers and refiners want bars. 3. Density. Easier to store 1,000 Oz in bars than tubes of coins. At $61.50, ignore the fancy stuff. Buy the cheapest, most recognizable government or corporate bullion. Maples, Eagles, 100 Oz bars, 10 Oz bars. Accumulate maximum grams before Samsung clears the shelf. Lane 2. Mining stocks. This is where life-changing wealth happens if you pick the right horse. Miners are the strategic reserve, but there's a trap. Hedging books. Imagine a miner, Loser Gold Corp. Last year, silver was $25. They hedged half production at $30 for 3 years. Today, silver is $61.50. They're selling at $30. Banks keep the extra $31.50. Their stock barely moves. They missed the party. Now imagine Winter Silver Inc. They believed in the shortage, refused to hedge, sell all ounces at spot price. Today, $61.50. If silver hits $100, they sell at $100. Operating leverage is massive. Cost to mine, $20. Sell at $30, $10 profit. Sell at $100, $80 profit. Price triples, profit 8x. Stock could rise 10 to 20x. Strategy, audit your miners. Read quarterly reports. Look at hedging and derivatives. Forward sales, run. You want 100% unhedged exposure, primary silver only. Most silver comes as a byproduct of lead or zinc mines. Those companies don't care about silver prices. It's just a bonus. You want a miner that lives and dies by silver. The Samsung scenario is creating a bidding war for these pure play companies. Battery makers could start buying equity in miners just to secure supply. If Samsung snaps up 10% of a junior miner, that stock goes to the moon overnight. Lane 3. Geography. This is critical for the battery metals story. The US and EU now require battery materials to come from friendly nations to qualify for EV tax credits. Buy silver from Russia or China. No credit. Buy from Nevada or Ontario. Huge credit. This creates a two-tier market. Clean silver versus dirty silver. Clean silver trades at a premium. Samsung and Tesla will pay more for metal from safe jurisdictions because it keeps their supply chain legal. Latin America is risky. Mexico and Peru dominate silver production. But as prices rise to $100, government seizures become likely. Labor strikes and blockades are already happening. Strategy. Tilt your portfolio toward Tier 1 jurisdictions, Canada, USA, Australia, stable laws, strategic allies, secure supply. A mine in Idaho is worth 5x more to Tesla than a mine in Bolivia, even if the silver content is identical. If your miner's assets are in countries with a history of seizing mines, that's a ticking time bomb. Exit strategy. I told you before not to sell for fiat, but eventually you will rotate out of this battery trade. Technology moves fast. Right now, the silver carbon anode dominates. It will drive demand for the next 5-10 years. But by 2035, maybe graphene anodes or sodium batteries replace silver. Commodity supercycles driven by tech usually last 7-10 years. Think uranium in the 2000s, cobalt in 2017. We're at year 0 of the silver battery cycle. The squeeze is just starting. Friday's 61.50, the starting line, stay vigilant. If a headline in 5 years announces a silver-free solid-state battery, that's your signal. The structural deficit may ease. For now, factories are being built for silver, locked into at least 2 product cycles. The Samsung bid is the floor under the silver price. Strategy, ride the S-curve. Accumulate now, hold through the mania, and eventually rotate into land or other assets when headlines become euphoric. Marry the macro, date the tech. Here's the playbook. Physical bars, weight over art, unhedged miners, leverage and exposure, safe jurisdictions, supply security. One immediate hurdle, Sunday night. Right now, the price is frozen at $61.50, but news of Samsung, halted refineries, and margin stress is circulating globally. When Asian markets open tomorrow, the market will vote on Friday's drop. Accept the low price or attack shorts, gapping the price back to 64. Sunday night, open prediction. The Shanghai Gold Exchange, SGE, is the heartbeat of the Asian market. Unlike the COMEX in New York, SGE trades physical metal. Friday's paper smash pushed NY silver to $61.50, but in Shanghai, premiums are exploding due to solar demand and battery tech. Silver on the street is trading $66.67. Opportunity? Arbitrage. Buy in New York at $61.50, sell in Shanghai at $67, a risk-free profit of $5.50 Aus. To capture it, traders buy COMEX contracts, forcing buying pressure and closing the gap. On Sunday night, expect this arbitrage to execute violently. Asian markets see factories being built, spot Western prices as a gift. The price could instantly gap to 63, 64, negating Friday's smash. Banks who shorted on Friday could be underwater by Sunday dinner, setting up a short squeeze on Monday. Psychological warfare ahead. Next week will be brutal, not for prices, but for your emotions. Banks know the Samsung narrative is taking hold. Vaults are empty. Their weapon? Volatility. expect swings. It's $3 one day, $3 the next. They want to induce motion sickness, force weak hands to sell. Remember, a $3 drop does not change solid-state battery chemistry. Margin hikes do not stop Samsung from needing 100 million ounces. Scary headlines on CNBC do not erase the structural deficit. The Samsung bomb has exploded. The shockwave hits Monday. The era of silver as a critical strategic metal is here. Silver back in the ground? No. The fundamentals are inelastic. Price swings are just noise. If you're checking the ticker every 5 minutes, you're playing their game. You're letting them rent space in your head. Instead, watch the premiums. Spot drops to $60, but the dealer still charges $80. That drop is fake. Inventory still shows out of stock? Fake. Paper prices will be weaponized against you, but the physical reality is your shield. Friday, the banks smashed silver to $61.96. They want you to believe the rally is over. That silver was just a speculative bubble that popped. They are lying. Not a little lie. A lie of omission so massive it borders on criminal negligence. While you were staring at the COMEX ticker, while algorithms dumped paper contracts in New York, something happened in South Korea that makes the paper price irrelevant. Something that changes the fundamental chemistry of the global energy transition. Samsung SDI, one of the largest battery manufacturers on the planet, quietly confirmed the specs for their new solid-state production line. The media calls it a battery breakthrough. 900-mile range, 9-minute charging, but they're missing the single most important detail. The detail Wall Street hasn't priced in, the detail mining companies aren't prepared for, the detail that makes a 1.1 billion ounce deficit look like pocket change. The secret ingredient? It's not lithium, not cobalt, not nickel, it's silver, and not just a trace. This is a massive structural increase in silver consumption per vehicle, a technology that transforms silver from a precious metal into a strategic energy metal. In this 4-part deep dive, I'll show you the silver bomb Samsung just dropped on the global supply chain. I'll walk through the chemistry of the silver carbon anode, do the math the IEA refuses to publish, proof that there isn't enough silver on Earth to electrify the fleet using this tech, and I'll show you why Friday's drop to $62 wasn't a crash. It was your last chance to buy silver before the auto industry realizes they've made a fatal miscalculation. The banks play a paper game. Samsung plays a physics game, and physics always wins. To understand why this is an extinction-level event for silver supply, we need some chemistry. Don't worry, I'll keep it simple. For 30 years, the world has run on lithium-ion batteries. Your phone, laptop, Tesla Model Y, they all use liquid electrolyte lithium-ion. Great batteries, but they have a fatal flaw, the dendrite. Charge too fast, charge too often, and lithium ions form needle-like crystals, dendrites. They grow jagged roots inside the battery. Eventually, they pierce the separator between anode and cathode. Boom! Short circuit, thermal runaway, fire. This is why EVs take 45 minutes to charge. Why they catch fire. Why they lose range in winter. The holy grail, solid-state batteries. No liquid, no fire risk, instant charging, double the range. Toyota, Volkswagen, and others promised this for a decade, but they failed. Why? They couldn't stop dendrites on the anode. Graphite anodes didn't work, silicon expanded too much, pure lithium metal was too unstable. Then Samsung SDI found the solution. One element applied as a nanocomposite layer stopped dendrites cold while letting lithium ions move freely. Stable, conductive, perfect. That element? Silver. Specifically, a silver carbon nanocomposite layer. This isn't theory, it's published science. Samsung's prototype cells use a thin layer of silver mixed with carbon to regulate lithium deposition. Silver acts as a host for lithium ions, dissolving them evenly, preventing spikes, allowing batteries to be smaller, lighter, faster, safer. The catch? To make this battery work, you need grams of silver, not micrograms. For the first time in history, silver is an active material in electrochemical storage. It's becoming part of the battery's DNA, and the auto industry is about to scale this to millions of cars. Still think it's just a little silver. Context. Standard combustion car, 15 to 20 degrees silver, switches, seat motors, defrosters, ECU, EV, 30-50 G silver, inverters, battery management, high voltage cables. EVs already strain the market. It's part of why we have a 1.1 billion ounce deficit. But the solid state battery changes everything. We're no longer talking switches. We're talking coating every anode in a 1000 lb battery pack. Samsung paper suggests silver loading of 5 to 10 gram per kilogram of anode material. Aggressive estimates go as high as 0.51 kilogram per vehicle for high-performance long-range packs. Let's be conservative, extremely conservative.